Welcome to the weekly video update, where I'll go over the action in the market for the week of March 3rd through the 7th, and we'll see how things look for the week of March 10th through the 14th. We got hit pretty hard this past week, and all the indexes ended up going down. We are still holding above support on the daily charts. We're a little bit above the 200-day moving average with the S&P, but all of our indicators are negative. We're still looking positive, though, in the long term. There are true criteria that I use for the long-term trend. On the daily side of looking at the charts, if we're above the 200-day moving average, that's positive. And then I use a 50-period moving average and a 200-period moving average. And if the 50 is above the 200, then we're in an uptrend there too. So there's really two aspects to that. And we're still looking positive that way. What we're wondering is if the other criteria is going to switch over negative, where we drop below the 200-day moving average. And we have a lot of different indexes that are at critical support. Now, some support has already been broken. We're below the 200-day moving averages on the NASDAQ and NASDAQ 100. And of course, the mid caps and small caps, they are not doing very well these days at all either. But a lot of this has to do with the uncertainty about Doge and tariffs. A lot of it's tariffs. That's really what has the most impact on the market right now. But it could switch to something else at any time. Okay, so a few notes just before I get going. I do videos every day. Now, I'll be rolling something out fairly soon where if you want to have access to the daily videos right as they are available, that'll be available on YouTube. It won't be free. It'll be $20 a month, but that'll give you immediate access. Now, I do have a program, and that's $97 a month. That's free right now, so you're welcome to go check that out. But you get the videos there right away. In fact, as I record this, all those videos have already been uploaded. I actually do a different video of the weekly version because I'm not talking about all this stuff because the members in the program know about everything I'm going to say right here. But feel free to check that out. And I'll have a trial period, both either here on YouTube and Rumble, and it'll be $20 a month. It's still free on the website for right now. I also have in the next spot here, I have a number of different newsletters that I've just been rolling out. Now, those are still kind of at rough draft stage. I'm kind of working out, okay, what format do I want to use? I have a daily video and then I have a weekly video. I'm doing an intermarket analysis video, and then newsletters accompany each one of these videos, and even the what to watch video and deep dive. That's going to be $8 a month. Not very expensive for the amount of information that it will give you. And some of you, that might be enough. I don't include a lot of the charts in there. I mainly just quickly going through and just saying, are we looking positive? Or are we looking negative? And so that might be something that you want to check out. If you're interested in the newsletter, go to the link to the website because that's where it's at right now. And that's where it will be. When I eventually roll this out, I'll set up another website. One thing I will not do is send these out as a PDF. And I've known other people that have done newsletters that way. And one person subscribes and then they forward it to 20 people and then 20 more people. And it's not that I don't want my information out there. It's just I want to maintain integrity into the system. And if I keep it on a website, it's less likely for that to happen. So okay, then there is a PDF that's available in every video that I upload. You can download it. You'll see what I'm looking at right now, not only the notes, but also the charts. And here's the link to the SPX investing program. It's also in the description below this video as well. So it'll take you right to that. And it's free. All you have to do is supply an email address. And then every day on the YouTube community tab, I update what are called pivot points. There's one based on a daily chart, and that the pivot points last for the whole month, but the chart is updated each day with a new bar for that particular day. And then there are new pivot points that are intraday, and they give us really useful support and resistance levels. And I just freely post those out on YouTube on the community tab, so feel free to check those out. I do have a private Facebook group, not really active, not a lot of people. If you want to change that, you're more than welcome to come in and give it a shot. It's another way of having access to me because I check that all the time without necessarily being involved in the program. But I need to hear some input from you I just post whenever I upload a video now. That's pretty much the only thing that's been going on there. And I really watch YouTube and Rumble comments. I'm really thinking strongly of disabling comments because I get so much garbage stuff. It's scammers that tell you that they're social media experts, and really all they're trying to do is get you to pay them some money for something that doesn't exist and all of that stuff. Because I used to teach security for Microsoft, so I know these games that are played out there. And I used to have to go find these games and then tell people about them. But if and then there's bot comments and just garbage comments and so forth. I get rid of those. But if you have a legitimate comment, I first of all I would recommend that you send me an email. I have an email address right here in the video where you can contact me, and it keeps it more private. And then if I do get an email, I know, oh, this is probably a little bit more legitimate. And but if you still want to leave a comment, you're more than welcome to do that. I don't get a lot of comments on my videos because I really watch those and I want the garbage ones to go away. But if you even if you disagree with something that I'm saying, that's okay. We can have back and forth debate. It's just the garbage stuff is what I want to get rid of. Okay, and then I post on YouTube and Rumble as well. All right, so for the week we were down 3.1%. My goodness. Yeah. And we would have been down over 3.5% had we not bounced up on Friday. And volume is still healthy. It's above average. And we are looking more negative. We're taking a hit now. And we're seeing it not only in the daily charts, but we're seeing it over here on the weekly charts. So the market's going to have to really come in with some buying to keep things positive. And of course, that's the other question. Are we going to actually start dropping down and look more negative? We don't know that right now. And anyone who says they do, they're trying to fortune tell. We look at real information here that tells us what's going on. There are some negative things to be sure, but there's also some positive things that we can hold on to. And inflation is still a concern, even though if you look at some of the market indicators that we use, and I go through them in this video and some of the other videos, the inflation expectations are actually coming down. But that doesn't mean it's not off the street, so to speak. They're, they're concerned that commodities are going up. And yeah, that can be inflationary when you have corn and wheat and fertilizer and stuff like that really going up. That can be inflationary because it ultimately will come through in the form of prices. Now, interest rates have been coming down, but they went up later on this week as well. And we're seeing more of a decoupling of that 4.5% to where stocks are at because we're under 4.5% right now with the 10-year yield. So stocks aren't as fixated on that. But if we really start to go back up with interest rates, stocks may become fixated again. And there are growth concerns as far as in the economy. We've been seeing weaker than expected economic reports, and that's spooking the market a bit. They want to see growth. And even earnings, they're still looking good going out, but they're being revised down. So that's a little bit to be concerned about too. And then, of course, geopolitical things. What's going on between Ukraine and the US as far as ending the Russia-Ukraine war? What about Europe stepping in? What about the tariffs? What about all these executive orders? What about Doge? It leaves a lot of question marks right now. And part of the debate going back and forth is, are we going to go into a recession? It still doesn't look that way right now, but if things still continue to look weaker, that could switch over. And then in Friday's session, Chairperson Powell came out and said, I kind of like how productivity is going right now. And I don't think we'll be doing anything too soon concerning interest rates. So at least they didn't change what the Fed has already been saying. Now, we are turning more negative with our trend, and I'll show you the chart to back this up here. We're starting to turn up and cross above the moving average, and the red line's above the green line, and that could suggest the potential for a negative trend that's just beginning longer term. Again, I'll show you that chart. Okay, so it was a really rough week for the stock market. Everything got taken out and shot. And there are growth concerns, inflation fears, tariff worries. These are what the market's really fixated on. And not only the markets, I mean, people are wondering too. It's like, what's this going to do to my job? I work for the government and I'm getting laid off, or, you know, What about inflation? It's costing me a fortune just to make an omelet these days. And then there is a real technical deterioration going on. Now, the bounce that we saw on Friday might have been a technical bounce because we were coming down to support. That support level held and we bounced up out of that. Are we going to stay above that? Or are we going to go down and actually break below that support? Then the trade war that we've been talking about has been heating up as 25% tariffs on Canada and Mexico went into effect. And there's a 20% tariff now on China. And of course, those countries are saying, well, if you put a tariff on us, we're going to put a tariff on you. So, you got this little thing going back and forth that countries like to do. And then the 25% tariff on Canada and Mexico, they were revised. And then, according to the USMCA agreement, and that's what Trump put through the first time he was president, that the compliant goods inside of that agreement, about 38% from Canada and about half of them from Mexico, will be exempt until April 2nd. So a little bit of an adjustment there. And of course, some people are saying, well, how come he announces this tariff and then he changes it or he revises it? My personal take on that is this is a negotiating tool where he's like, okay, we're going to put a 25% tariff on you. Well, then Canada or Mexico comes and talks and they say, okay, let's try to work this out. Where Trump is still not afraid to put the full tariff on, or at least not take it off. So yeah, this is a negotiating tool, and when you negotiate, things do change. The economic reports, there were some that were stronger than expected, but we're seeing most of the reports right now coming in weaker than expected, and that's producing growth concerns with the economy. And we did fall down below the 200-day moving average, which equates to a 50-week moving average here on the weekly charts. But we were able to get back above that. So that's long-term support that's holding for right now. Interest rates did go back up. A week ago, we were at 4.23%. We closed on Friday at 4.32%. And the dollar's just getting smacked something fierce right now. A week ago, it was up into the high 107 range. It's now down into the 103 range. And some of that could be going on with the tariffs and with between Ukraine and Russia and where the US is going to play a role and where Europe's going to play a role and all of that. Okay, so the Dow is down 2.4%, down 3.5% with the NASDAQ, 3.1% with the S&P, and a mighty 4% down with the small caps. And this is something I've been bringing out for a long time now, that are we going back up into this blue, dark blue line here where inflation starts to pick up? We don't know that for sure, but there's some concerns about that. And there's some justification for that, as inflation might be coming in hotter than expected. Now, this week's going to be an important week because CPI is going to come out and PPI is going to come out, and those are two big inflation reports. So that might help clear things up, or it might make them even more cloudy. All right, and we're above this 4.02% level here with the 10-year yield. We're at 4.32%. And it doesn't mean that corporate profits are negative. It just means that they're being revised down. They're not as robust as they were before. Now, this was updated. We're actually seeing a drop off here of those folks that have been unemployed for over or 27 weeks and over, long-term unemployed. All right, then this hasn't been updated in a little while, but we're still going up and to the right as far as estimates for earnings going out, even though these numbers have been coming down. Then Goldman Sachs came out and said, well, we're going to bump up our recession probability. Well, not very much, from 15 to 20%, but they did bump it up, where the Bloomberg consensus is at about 25%. And then this comes out whenever we get the employment situation report, where we're still below this red line. Now, other times when we come down and drop below this horizontal red line, we usually go into a recession. That didn't happen this time. Are we going to go up above this red line and then turn and come back down and then go into a recession? It's a guess at this point. Then looking at equities generally do better than corporate bonds. Yes, yeah, they do. The blue line, this is the S&P, even with the recent weakness, it's still been outperforming. Where we have the pink line here, those are junk bonds, and they tend to do better, but they're also riskier, but they give you a higher yield. And then this white line down here are US grade or high grade US bonds down here. Okay, not a real mystery there. And then I don't do this, I don't teach this, I don't personally participate in this, But a lot of the 0 day options that we see, it's zero DTE. That's kind of all the rage right now. That's accounting for an awful lot of the option volume that we're seeing. All right, then looking at FactSet, we're seeing a real rise in those companies that are citing tariffs when they do their earnings calls. Yeah, that's what the current fixation is all about, as it should be, because it's what's really happening. Now, here's the intraday chart. We go back to Monday where we were doing okay here, but then we saw some late day selling come in. But then on Tuesday and Wednesday, we actually saw some late day buying, and this was showing that our growth to value ratios were improving a little bit. And I mentioned that in the daily video that we're possibly seeing some improvements here. Well, that didn't last into Thursday. We gapped lower, tried to come up, and then ended up going down. And then Friday, after the employment situation report came out, we did go down, and right around here is the 200-day moving average. And then later in the day, we were able to come up out of that. Was this the actual smart money coming in and buying, or was this just a technical bounce? Because we've been going down pretty ferociously over the past few sessions. Now, for the week, and this just measures the 5 trading days, all of the indexes were down, with the S&P 500 actually being down the most. And we go back to the beginning of the year, we still have the NYSE index that's positive, and the Dow. It's been holding up a little bit better as well. But there's a positive side and the negative side for the NYSE still holding up. The positive side is it's still positive. The negative side is there's a lot of value in here, and folks might be rotating out of growth and getting into value, which is keeping this broader market measure positive, where some of our other growth areas are seeing a little bit more weakness. All right, then looking at the sectors, we were down with financials, and we're watching this. We're a little bit concerned about this. It was going into the great financial crisis. If you really watch the charts, it was giving some telltale signs that something was wrong there. And so we're just keeping an eye on it, but it's still positive for now. We just want to watch it. And then discretionary has just been getting hit hard, and a lot of that has to do with weakness in Tesla. There was one sector that was up, and that's healthcare, and that's more of a defensive area. Then I ranked them over here, looking on the right-hand side. This is the scooter score on a scale of 0 to 100. If you're in the 90s or above, that's looking good. And even with the weakness, communication is still looking about the best. And then we drop down into the high to mid 70s here with staples, which is defensive, and then financial, which had been strong but showing some weakness now. And then you look down here at the bottom, tech is not doing very well right now. That's the weaker sector. Then looking at the sectors where we see financials ended up being down the most here, just want to watch that. And then discretionary and tech, they're down year to date. We still have communication. That's the green area right here. That's positive. But we want to see communication, tech, and discretionary. Those need to be the leading areas when we're really going up. And you see healthcare, yeah, it's a defensive area, and it's been performing the best so far in 2025. This is the relative rotation graph. If you go back to your geometry class, we're in the plus plus area up here. Nothing's really all that strong right now. We still see communication holding up fairly well. Energy's been coming on a bit, but then tech, or discretionary, excuse me, has been coming down and showing some weakness. But we are possibly seeing some rotation here. Now, this is a 1 year look, so it can take some time for these things to actually develop. But right now we have the financials and communication. Those are the two more positive areas, even though they've been showing some weakness. More neutral is discretionary, where negative areas have been tech and the industrials. And then we have areas that are showing some improvement. They're in blue here. And I won't read through all of this, but a lot of these are more growth oriented. I'm sorry, more value oriented, or they tend to move more with what's going on in the economy. And here's looking at the different indexes where we're seeing a leadership showing some weakness. This is the NASDAQ 100 and actually rolling over now. And the S&P 100, which are the biggest stocks that make up the S&P 500, they've been under pressure. Now, the reason why the S&P is holding up a little bit better is it has growth and value together. The Dow's holding up okay right now, and the S&P is holding up okay. Not going up, but not going down like some other indexes are. And then we're seeing utilities coming back up a little bit, showing some strength. Another defensive area. So we have the S&P 100 is still green, where we're yellow here, neutral. with the NASDAQ 100, where the areas that are showing some weakness are the mid caps, transports, and small caps, where more positive would be the S&P itself, the Dow Jones Composite Average, and the utilities. Sentiment. Now, this is something that's not normal that's happening here. Let me go over here to this chart. When we come down with sentiment and we get down around this 25 level, you see where we come down and we bounce up out of it. We come down, we bounce up out of it. Come down, bounce up, at least for a little bit there. Well, we've come down here and we're just camped down along here. So folks are pessimistic on the market, but it's not bringing in any buyers. We usually use this as a contrarian indicator, looking at that this is a buying opportunity when we get really low readings like this. We're just kind of sitting down here for now. Then the active asset managers pulling off a little more negative on things right now, but pretty much considered neutral, coming in at 74.96 right now. We get concerned if they go above 90. We're really concerned if they go above 100. That's when we use it as a contrarian indicator. And we're going up with the VIX. We're above 20 here, and that's when we see negative annualized returns. The line chart is the closing basis for the week, and then we have the bar chart down below. Now, this goes in the face of some research that I've used and actually seen played out in the real world. But this chart goes against that. So this is suggesting that the VIX, when it goes up, we actually see better returns because it's more volatility. And now, usually when folks talk about volatility in the market, they mean it's going down. But volatility, well, it's like a bouncing ball. It can go down, but then it bounces back up. And maybe that's what this chart is honing in on here. Because if I look at the next chart, and this is done by Tom Bally, who's connected to stockcharts.com and earningbeats.com, he did the research behind this. And when we get above 20, we see negative annualized returns. When we're 20 or below, that's when we see positive annualized returns. And the more we go under 20, the higher those annualized returns tend to be. So that's just the opposite of the chart we just got done looking at. So it's like, take your pick. Okay, we're going a little bit more negative here with sentiment according to this Goldman Sachs indicator here. And we're seeing a little bit of weakness. We're coming back up into the red cloud here. We want this line to go down. That's when the market's more positive. When it starts going up, we're a little bit more negative. And a little bit of a pickup here with the bearish stance when we look at the Ridex bear bull ratio. And for 2 weeks in a row, the individual investors out there, they're extremely pessimistic about things. Now, we use this as a contrarian indicator too, but for them to be down here 2 weeks in a row, a lot of times we just come down and then bounce up out of it, come down and bounce up out of it. That's not happening this time. And we're coming up here with the weekly chart of the Ulcer Index. We're getting a very high reading on the daily chart. We're keeping an eye on this too, and it's actually the next chart that tells us what's going on. This is an inverted version of the previous chart. When this is coming down, that means there's risk developing between junk bonds and more risk-free government bonds. So this going down is a concern to us. That means fear is increasing. We want this to go back up. That means there's not a lot of fear. But if this keeps falling, now I use this more like a sentiment gauge because we're involved in the stock market in the videos that I do here, but we just want to keep an eye on this one. And we're seeing a pickup in the VIX, that's short term with the 3-month average of the VIX that's spread out over time. That means we're showing an increase in volatility more to right now. And we're also still declining here, but possibly hitting a bit of a bottom with our long-term equity put call ratio chart. When this is going down, typically the market's going up because that means there's less puts being used to hedge. And when this is going up, that means the market usually is under pressure. And this goes back into 2021 and into 2022. So we're still positive here, but if we see a real shift, that's going to change things potentially. Now, looking at the economy, the recent reading from the Chicago National Financial Conditions Index, we're below this black line, which is good. When we get concerned if we go above the black line here. And this is kind of what's causing a bit of a stir. We're getting from the Atlanta Fed GDP now is coming out negative. Now that happened a week ago, and I pointed it out in last week's video, but they revised it even down a little bit more, and that's a bit of a concern. So this is the Atlanta Fed. But if you go to the New York Fed, they're still positive. Don't you think these guys would email each other or at least, compare notes or something? They're coming down, but they're still at 2.67, where the Atlanta folks, maybe in the South, they're more pessimistic. I don't know. But they're actually coming in negative with that. And this is the Atlanta GDP now. We're coming in negative. We'll have to see if that changes. Now, this is actually coming down a little bit too. This is the real-time SOM rule recession indicator. When we came up over the red line, that was a concern. That's zero point 0.5. Well, we've dropped back down below it because other times when we get above this red line, you can see these grayed areas. That's when we went into a recession. Well, to this point, it hasn't happened. And if this keeps going back down, that might actually mean that we might avoid a recession. But there's other charts that we look at that suggest we could go into a recession. And this one's not really changing all that much. The smooth US recession probabilities, we get concerned if we go up to the black line. We're really concerned if we get up to the red line. And I was seeing a little bit of a drop off here with the leading index after it had become kind of high here. Other times when it really goes up, that's usually when we go into a recession, but not this time, at least yet. Then inflation, we haven't seen much of a change here. It did tick up a week ago, but it's not really gyrating all over the place. We are going to get CPI and PPI in the upcoming week. And now there's an 88% chance that the Fed is going to leave rates the same when they meet on March 19th. And that's pretty much been, this is the black, excuse me, the blue is right now, day ago, week ago, month ago. They're pretty much locked into that because the Fed's come out and pretty much said that. Then looking out at the May 7th meeting, it's almost across the board. It's a coin toss at this point. And this will adjust and go up and down as economic reports come out and things happen with the tariffs. And then looking at the Fed balance sheet, where it has been decreasing overall going back to June of 2022, but on a year-over-year basis, we're still having a tendency to go up. And then this is the overnight reverse repurchase agreements. We spiked up when I did this video a week ago. I was a little bit concerned about this. Now we're coming back down a little bit. So nothing really weird is happening here. And this really has to do with some of the big banks. All right, we're still positive when we look at the advanced decline line based on price and volume. Taking a bit of a hit here, and we're still looking good on the daily side. And it's not that people are selling. The advanced decline lines are holding up because there could be rotation going on. That's what it appears to be. But we're seeing a little bit of weakness here, not only on the daily side, but here on the weekly side. We're going down with the 4-week average of the highs and lows, and we're starting to go back down with the 10-week moving average as well. We actually ticked up a little bit here. We were down 3.1%, and the advanced decline ratio actually came up. That means there's some buying going on that's being picked up by some of these indicators. Now, this is turning more negative now and could even develop into something even more negative. This is the ADX. We're turning up. That's the black line. That's the ADX itself. And then I put the moving average on here. We're starting to cross above the moving average. That means a trend is beginning. It won't be a confirmed trend unless we go above 20. But the red line is going up and above, where the green line's below and going down. That means it's negative. So this could be starting to tell us in the longer term that we're going into a negative trending environment. Now, it could change, but we just go with what we're seeing right now. We're still looking positive here with the Arun, which tries to measure buyers from sellers. It's coming up with a positive result. That's why the oscillator here is above zero and giving a very high reading. We're seeing a mass index on the daily side that I've been talking about, so please feel free to check that out. This tries to pick out a reversal. So we've been coming down, and if this triggers a signal, it might suggest that we could go up. But we're not seeing that here on the weekly chart. And long term, we're dealing with the 200-day moving average right here when we look on the daily chart. We fell down below it, but we were able to close back above it. Long term, 50-week moving average coming down here, but still above an advancing red line. So we haven't switched over positive or negative there yet. And we're out taking a bit of a hit here. We're coming down to the 50-week moving average, and we're below the 13-week moving average, but we're still going up with the blue line and the red line. And this is probably offering overhead resistance here. We hit this in early December, and that's when things really started to slow down. This is the upper end of a long-term trend channel going back to 2009. We're not really hitting anything here with our pivot points. We're above the pivot. If we come down here at the 55.75 level, that's still a couple hundred points away from where we're at, but we'll see if this ends up providing support. Now, we're looking positive here with the smart money indicator. This is accumulation distribution. It's coming down, but it's still above an advancing moving average. So that's where we see this as positive, even though showing some recent weakness. And dropping a little bit below the midpoint here with the McClellan oscillator. And we're starting to come down, but still positive with the summation index based on price. We're dropping below zero here based on volume. And the bullish percent index looking pretty weak right now, both on the daily side and here on the weekly side. Below 50 and declining. That's negative. And here's the smart money indicator number two. Even though it's green, we're going down with the red line going down. That's negative. And the Chaikin oscillator going down. That's negative as well. And dropping a little bit below zero here based on price and volume when we look at the Swinland trading oscillator, that's more negative. And momentum has been negative and is now looking even more negative. We're coming down based on price and volume. And when we look at the PMOs inside of the S&P, we've been just chopping around here, not showing a lot of conviction, although seeing some recent weakness. The buy signals are declining, and we're going down with the PMOs that are above zero. But all three of these indicators are kind of around their midpoint, which just means there's not a lot of conviction right now. And we're dropping below the midpoint and declining with our percent B indicator. We got down below the lower Bollinger Band, but we were able to close back in above it by Friday. But the momentum is clearly negative with the short, intermediate, and long term. And this momentum oscillator is also negative, the Copic curve. We're negative with the force index. We're negative with the money flow. We're below 50 and declining. And we saw a down week of over 3% here with the rate of change. And we're going down with the 50-week rate of change as well, as we're seeing a little bit of damage done to the long-term trend. We're still positive here with the special K weekly chart. We're also still positive on the daily side, but it's rolling over a bit. And we're extreme negative already here with the Stochh RSI. That's showing negative momentum. And we're really coming down here with the Williams percent R, but it's not quite extreme, at least yet. We're dropping below 50 with the RSI based on 14 weeks. And we're coming down, but still slightly above 50 with the ultimate oscillator. And we crossed over negative here. The red line's going above the green line with the vortex. That's turning more negative longer term. But this is positive. This 40-week moving average here, we closed right at that. We fell down below it, and then we were able to come back up and close. Now, are we going to bounce up off of that? Or are we going to just end up falling down below it? We don't know the answer to that right now. The market could go either way and justify doing so. All right, we are negative when we look at our longer term charts here based on trend with the Heikin Ashi. We're also negative with the Kegi chart. We're still positive with the Renko chart, but we're turning more negative with the three-line break. So we're negative with our trends, except for the Renko. And we're showing some more zeros here with the point and figure chart. That's also more negative with a double bottom breakdown. And we're below zero and declining with the ease of movement going back 14 weeks. We're coming down with our long-term momentum, intermediate-term momentum, and our short-term momentum. So yeah, there's some weakness that's being generated right now as we've been coming down and dropping below these moving averages. And we're negative with the Elder's Impulse system for the S&P on the weekly chart, and this is a big change. We now have a dot on top for the parabolic SAR. We had been positive with the dots underneath. This is a change to negative. And we're negative in the short and intermediate term with all the different stock indexes that we follow. We're positive with bonds in the short and intermediate term, or commodities are negative in the short term. And the dollar's just been getting hit in the short and intermediate term. And I'll show you a chart later there. Then the S&P has been under pressure, but we're seeing even more pressure here with the mid caps and even more with the small caps, where we're just kind of coming below this previous low here, where we've already dropped below it with the mid caps and small caps. And seeing some weakness in the Dow, but it's been holding up better. If you look at the deep dive video, it's the best looking index right now. It's not doing great, but it's in first place. It's like the first among losers right now. And we're coming down and dealing with the longer term moving average here with the NASDAQ. Now, we've already dropped below on the 200-day moving average. We're right about at it here with the 50-week moving average and coming down and dealing with the NASDAQ 100 50-week moving average. And we see three red candles here as we've been seeing some weakness with the NASDAQ 100. Mid caps, seeing more weakness. We're dropping below the 50-week moving average, and we're also dropping below with the small caps. Now, the NYSE, this is just a little bit below its 13-week moving average. And this is what I said, there's a lot of value in here. And so this is holding up a little bit better. The Wilshire, this is a daily chart where we fell down underneath the 200-day moving average, but we were able to close back above it on Friday. And seeing a little bit of weakness here when we look at US versus world stocks. Now, this is interesting because world stocks are actually outperforming US stocks so far in 2025. That's why this chart's holding up a little bit better. It's not because of the US. The FANG index also dealing with its longer term moving average. ARC also dealing with its longer term moving average, even though it did bounce up off of that. We're watching the banks. This is a longer term chart of the KBW bank index coming down with the RSI, coming down with price, coming down with momentum. And then seasonality, where March, going back to 2021, is up 80% of the time with a return of 2.3%. And looking at traditional Dow theory, this is just the Dow where we're seeing more weakness right now out of the transports. I also include the utilities, and they've been kind of going sideways and holding up a little bit better than the transports. And this is commodities. We look at a weekly chart here, it's in an uptrend, and that's what's causing some concern as these prices go up. And this could be inflationary, where oil's actually been going down. We dropped under 70. This is the dollar, where just a week ago, couple weeks ago, beginning of the year, we were into the 109 range. Now we're dropping to the 103 range. This is a big drop right here. And some of that's probably induced by all this tariff stuff going on. It was going up when, hey, I'm going to put tariffs on you, and then coming down, whoop, tariffs are actually on you now. And so it could be some of that maneuvering going on there. And now this is actually more encouraging if you're looking at the economy. We're in an uptrend here with copper, and it was actually up over 3.5%. This is used as a barometer of the economy. And when copper does well, the market anyway, the copper market thinks that the economy is going to be doing pretty well. And we're switching over to an uptrend on the daily chart as well. Gold is still in an uptrend. Silver is also still in an uptrend. And we're going back up still here based on price with the total bond ETF. And we're taking a bit of a hit with our stock to bond monthly chart ratio here. But it's still going up, meaning stocks are outperforming. And we're keeping an eye on the 10-year yield in Japan in case that ends up becoming a bit of an issue like it did last summer. Then we look at gold, which is still the best performing asset so far in 2025. Bonds, believe it or not, are in second place. And then we have stocks, the dollar, and oil, which are negative year to date. The NASDAQ 100 is starting to underperform the S&P 500. Now, the NASDAQ 100 in a more solid environment, like when we were going up here and when we were coming up in 2023, we want this to go up, but it's really been going sideways for a lot of 2024 and now is starting to come down. The S&P 100 is still longer term outperforming the S&P 500, but it is showing some weakness. And growth to value. Growth has been outperforming, but now it's been pulling back. Are we seeing a longer term shift? We don't know the answer to that, at least yet. Gold, it's not that gold has been doing great, it's that the S&P has been going down, and so we're seeing this ratio going up. And bonds are still underperforming longer term with stocks, but it's coming back up to this red line. And gold has also been outperforming the dollar. And again, it's not because of gold, it's because the dollar's been going down. And the low volatility to S&P 500 ratio, this is really starting to spike back up. We haven't switched the trends yet. And you can see back what happened in 2022 when we were going down. If this really starts to go into an uptrend, that's going to cause some more concern. Energy has been underperforming tech, but lately it's been bouncing back up on a ratio basis. And discretionary had been outperforming staples, but now it's really pulling back. And the small caps, which are doing bad, and tech, which has been under pressure. And so we're seeing this ratio pretty much going sideways right now. Then longer term, not really seeing anything here with the NYSE breadth thrust or with the ZWAG NYSE breadth thrust. No signals there. Longer term, we're still above this long-term trend line going back to the 1987 crash. This is a further blow up of that same chart. Even though we're coming down, we're still above this trend line. We're still giving a full-on Zohorchak method buy signal. And we're seeing a little more negativity here. We're dropping below this trend line with the NASDAQ weekly chart, NASDAQ 100 weekly chart. And a little bit of weakness here with the new highs, new lows on the NYSE. And then this is a 50 period moving average. So we're holding up here, but we're right around the midpoint where we're coming down, but still holding up okay for the time being with the S&P 500 new highs, new lows. And then this red line is a 50 period moving average of those new highs and new lows. And we're holding up okay here with the NASDAQ 100. That's growth. The Dow, that's considered value, even though NVIDIA and Microsoft, they're in the Dow. But this ratio is holding up fairly well right now. And the Qs, growth versus IWM, that's small caps. And, and it's not the Qs are doing good, it's the small caps are doing so bad. That's why we're seeing this ratio going up. And we're keeping an eye on the 3-month yield. It's been going sideways going back to late 2024. And we're seeing a little bit of a drop off here with the cumulative new highs, new lows for the NASDAQ. That's longer term. That's why I show it in the weekly video here. Seasonality, we tend to be positive 65% of the time in March and up 1%. We'll see if that hangs for this year. And November to April, we're up 77% of the time with an average return of 7.1%. The first half of March is the second best performing time of the year, going back to 1950 with the first half of July. And that's really benefits tech then, but we're not seeing it so far. And then when we have an election, the post-election year, the first quarter can quite often be quite non-productive. We don't see much of a change. This is a composite where we're actually coming down. This was a week ago when I had this chart, and we've even dropped a little bit more since then. So it can be pretty choppy here until we get into April, and that's usually when we see things improve, according to this chart. And also, the second half of March tends to be green. This is according to Carson. Once we get past the midpoint, which will be the end of next week, then things often turn more positive. Now, we are getting a Hindenburg-Ullman signal right now, but it's not confirmed. If you don't know what that is, please pause this and read this part over here. And we just saw the initial spike. What we need to see now is another spike before, on or before March 31st. That's 20 trading days from when the first spike was generated. And you can see when we had multiple spikes here, this is right before the COVID crash. Right here, this is the end of 2021. Are we going to see more of these spikes going forward? Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.